Kelvin Tay is Chief Investment Strategist at UBS Wealth Management and joins us from Singapore. And Kelvin, I wanted to get on to the export growth and import figures, of course, for China. Export growth is cooling for China for a fourth month. That was expected, but crucially, it seems, imports are down much more than expected. Is this a reflection of slowing demand and falling consumer confidence in China, or is it just greater demand for domestic products?
I think it's a combination of both, and actually the figures didn't really surprise us very much. We do expect a slowdown in the domestic economy for a little bit first, before China actually starts growing again towards the end of the first quarter of this year. And that's one of the reasons why the government has actually come in with measures to actually reduce the reserve requirement ratio just a couple of weeks ago. And we expect that to actually happen in the next couple of quarters as well. And don't forget that we also think that the Chinese government is likely to stimulate the economy to the tune of 2 to 3% of GDP sometime in 2012.
So, Kelvin, what do you think this all means for the yuan? We see it strengthening, but at a slower pace, it would seem. Do you expect that for 2012?
Certainly. We still think that the yuan is going to appreciate by about between 3 to 5% against the US dollar. If things really fall off the cliff here, the Chinese government is likely to actually peg the yuan back to the US dollar, like what we saw in 2008 during the Lehman Brothers crisis. But we certainly do not think that's going to happen anytime soon. What they've done recently is actually has been quite effective in slowing the rate of inflation. And we believe that inflation actually peaked in July last year, and therefore we are not likely to see inflation back at the kind of levels that we saw in July 2011. And that's why we think that credit easing could possibly kick in much earlier than expected. Certainly, when the Chinese government cut the reserve requirement ratio last year, it came much earlier than expected because we were actually looking at a cut in the first quarter of this year.
And Kelvin, talk to me about exports because, of course, there is signs that they are slowing as expected. But is this an ongoing concern for China, or should actually an improving US economy help Chinese exports later in the year?
Yeah, I mean, that's a good point. The US economy has actually been very surprising, and the growth momentum there seems to be pretty strong. If you go by the figures that the economy has been spewing out over the last few weeks. More importantly, the jobless numbers have actually come down, and such that unemployment as of last Friday's numbers are basically at about 8.6%. What's helping the US economy is basically the lower gasoline prices in the second half of last year as well, which in turn basically meant that the Americans have more disposable income to actually consume. And that's again positive for China because, again, the US is still one of China's biggest export markets, so to speak. So this is actually now turning into a slightly virtuous cycle where the US economy is concerned. And that in turn is actually positive for China. But we need to look out for oil prices here, because if oil prices go back to the $125, $135 per barrel levels here, then again this might actually stall to a certain extent.
I see. So some positive signs coming from the US for China, but still keeping an eye on oil. Kelvin Tay, Chief Investment Strategist at UBS Wealth Management. We'll be talking to you again a little later in the programme, getting your thoughts on the US earnings season. Thank you. And Kelvin, we saw a quarterly loss, the first quarterly loss in more than 2 years for Alcoa as its prices fell. Concern that a global slowdown, is that going to hurt the rest of the earnings for the fourth quarter across the board in whichever industry groups?
Yeah, I don't think we can actually just generalize across the board, and I think we need to look at things in terms of the sector basis. The commodity sector is obviously going to face some difficult times because of the fact that commodity prices have actually come off a little bit in the second half of last year. But I think where the other sectors are concerned, particularly in the consumer sector, things could probably be a little bit more sanguine in the sense that we believe that the easing credit conditions in the US economy right now should actually help consumption actually improve in the last few quarters. But then again, that could maybe not come in time for the quarterly results in the last quarter of last year.
I think what was notable with Alcoa, of course, is that we actually saw the stock price rise in after hours. Have therefore stocks, to much of an extent, priced in these poor fourth quarterly results?
Yeah, I think bearing in mind that the whole Eurozone crisis actually blew up in September, a lot of the business and consumer confidence were actually badly dented in October. But when the US economy started spewing out pretty positive figures in November and December, again, people started buying and consuming goods and services. So I think in a certain way, we can't generalize across the board like that. And I think with expectations already set below the bar, like in the case of Alcoa here, that any company that actually reports earnings that are actually ahead or in line with expectations could possibly actually surprise the market. And that's one of the reasons why we think that perhaps it might not be this bad this time round, because expectations have actually been set a lot lower than before.
And obviously what's driving down those expectations, as you mentioned, is the European debt crisis. I understand you believe that Greece is likely to default come March. Do you still believe that, and will it exit the euro, therefore?
Certainly. We believe that Greece will actually default in March, but we think that the question right now is not whether they will default or not. It's how is the default going to be handled. Is it going to be orderly, is it going to be managed, or is it going to be a disorderly, chaotic default? Because that in turn has repercussions on how potential defaults in the other Eurozone countries are likely to be handled. And that's actually quite an important barometer for us.
So clearly, Kelvin, volatility here to stay. Where, therefore, are you advising people to put their money? Is it still all about Asia, about Chinese equities?
Yes, certainly. We've been saying this for a very long time, but I think right now we are pretty much close to the bottom at this point in time. The markets have de-risked. Foreign institutional investor flows in Asia have actually been quite low for quite some time right now. Last year, in fact, we saw negative flows in compared to the previous few years. And therefore, to a large extent, with valuations cheap and sentiment at an all-time low, it might not be that bad an idea to actually start taking some positions in the markets. Therefore, we think that right now it's probably the best time to actually start dollar cost averaging back into the markets.
So time to get back in, dip your toe back in. Kelvin Tay, Chief Investment Strategist at UBS Wealth Management. Thank you for all your insights and your optimistic view on Chinese equities.